to have you. Thank you so much.
Happy to see you, my friend. Good to be here.
Thank you. Thank you. You established the firm in 2000. You've invested in 650 transactions, over $350 billion. You saw something nobody saw, the software enterprise then. Now, everyone is questioning the software enterprise, okay? Always people will question whatever you do.
Right.
So walk us through your thinking. I know you always think as an engineer, and that would be good to hear how you've been going through this journey.
The way to think about this is enterprise software. You know, as you said, you know, I started my career as an engineer, started at a place called Bell Laboratories. And Bell Laboratories was really focused on inventions and bringing technology forward. And one of the areas that they were focused on was bringing full solutions. These were hardware, firmware, software all together, delivering solutions. You know, the switching systems, the PBXs that ultimately created connectivity and efficient digital connectivity between, you know, institutions and companies and individuals. And what was interesting is when you start to understand the productivity nature of what technology would bring. And, you know, you fast forward. I finished my degree in chemical engineering, and my generation of chemical engineers, while we focused on what we call unit operations and, you know, oil field services, et cetera, we really started focusing on process controls. And when you were, you know, in early processes, as you controlled them, they were often analog or manual processes. You had a episodic observation where an operator would observe an event. Then you had an episodic intervention. An intervention was that operator would go in and make a change to something that was happening in the process. And, you know, the cycle of control dynamic looks something like this. Well, when you implemented a process control, a digital process control, you went from episodic observation to really a continuous observation, you know, sometimes, you know, hundreds of times a second. And from that, you could actually then intervene at a higher frequency. So you went from a control dynamic that looked like this to a control dynamic that looked like that. And so everything under the curve, you know, as a mathematician, is waste. And so that's the effect that software or technology had in process industries. And then once we were able to build out capacity for delivering, you know, silicon, Moore's law at lower and lower costs, we were able to distribute that capability across not just process industries, but into offices, which created a massive extraction of waste in our systems. That waste is read as productivity. So productivity immediately accelerated globally as a result of the introduction of technology. Well, over time, there was a separation, in essence, of these tech stacks into hardware and to software. And as that happened, ultimately all of the value ultimately accrues to the software. You know, there's waves that happen. The first wave's typically the hardware vendors. They're building the silicon, they'll capture the first value, which we're seeing in this latest one with artificial intelligence. Then you have often infrastructure providers that are providing the services to support the adoption rate of software. But ultimately the long term is those who are actually bringing applications that bring productivity to their customers, to the businesses, to the consumer, capture the lion's share of what we call the economic rent associated with technology. That hasn't changed. You know, the implementation of enterprise software, in essence, codified that software layer of capturing value for now decades. And in fact, it has been the most productive tool introduced in our business economy over the last 50 years. Well, this new introduction of artificial intelligence will enable enterprise software to actually become even more productive, because it goes from software as a product, and then we went to software as a service, SaaS. Now will be software as a worker. You know, these workers, these, you know, agents, agentic systems will be, you know, will be software that is operating within workflows of enterprise software companies to create that productivity. They do it 24/7, 365. So if you think about episodic observation, episodic intervention, to now continuous observation, continuous intervention to create value and productivity, and it will extract even more waste out of production systems and, you know, commercial systems. So it's a linear progression, in essence, of productivity that enterprise software is bringing really to the global economy in every single industry. So that's a dynamic that we're seeing today.
When you started, it was a limited opportunities. Today, the opportunities are a lot more, but valuations are also a lot higher. How do you position your firm to be the partner of those innovators?
What's interesting is, software has always gone through what we call re-rating cycles. When we finally software got to the point where it was affordable, companies would buy it, and they bought it as a product, and you would install it. If you had a software, you'd buy this product, someone would ship it to you. Sometimes installed on a server, sometimes in a DVD format, and you'd upload it, okay, onto your servers, and then you'd operate it. And every time there was an upgrade, they'd ship you a new, DVD, and you'd upload it. Well, then there was a new, technological shift where we could now host the software and make it accessible through connectivity enablement, the internet. Okay, now I can go through a browser, and I can actually engage in my enterprise software environment. And so that decreased a lot of the friction of these upgrades. So now you can make one change and affect thousands of customers at the same time. So that, in effect, created a new paradigm, a new business model. So software then re-rated, okay? Because you went from someone buying a product, a license, and maintenance, to now a subscription. Well, what does that mean? That means more visibility on the revenues. And because software is a zero CapEx business in essence, when you have more predictability, you actually could create a terminal value evaluation and now increase what is the value of that customer. So software re-rated and went to a higher multiple. Well, the real question today is, what is AI going to do to the business models of software and software as a service? I think what's going to happen is going to be a dispersion of outcomes. For those companies that become agentic. Agentic means creating agents that operate within these workflows. Think about what they're actually able to do. They are actually becoming workers. So now you're going from software as a service to software as a worker. And that worker, like I said, works 24/7, 365, doesn't ask for benefits, it asks for tokens, i.e. it's asking for inference in order to operate. But it actually is a lot more productive. And if you build these systems right, it'll have more context, the ability to absorb more information than human beings in many cases, to act on it and to do it at a higher frequency. So it should actually have a much higher terminal value, because now you're actually using artificial intelligence to enable enterprise software to eat services. And so that should have a higher terminal value. And typically for most businesses, their services component is a multiple of their software spend. So there's those dynamics that increase the terminal value. So there should be a re-rating again. What's happening in the market today is there just aren't enough proof points of that, because it's new, that people can say, okay, well, here's the acceleration of the terminal values, and so now let me re-rate the software company. So that's why it's an interesting time to buy for those sort of companies. With all that said, not every enterprise software company is going to make that transition. Some really won't have what we call a right to thrive in that environment, because they haven't built out something that's protectable. These agents, these platforms, artificial intelligence, what it can do is actually very efficient search engines at the end of the day. And as a result of that, if your business is only based on content that is readily available, and available, in accessible in different forms, and can be understood and used, then you really don't have a right to exist in this new paradigm of environment. If, however, you're an enterprise and you have unique, what we call sovereignty and dominion over your workflows and data sets, you not only have a right to exist, but you have a right to thrive. And the interesting thing about enterprise software, in terms of what our opportunity is, less than 1% of enterprise data actually exist in public environments. So these large models have not been trained on enterprise data. And that's a huge advantage. 99% sits within the walls of the insurance companies, the finance companies, the logistics companies, et cetera. And if they are judicious in the way that they are implementing these solutions, they will not leach enterprise value into these large-scale models. In fact, Satya Nadella spoke about this at Davos this past year, where he talks about this is something that people are going to have to understand. In essence, you need to bring these models to the data, not your data to the model, because if you are taking your data to the model, you are basically, exporting value into someone else's model somewhere else. Your data, your information, your intellectual property, then you are now exporting into someone else's environment that they can then exploit, as opposed to taking those models and putting them in your environment and using them to operate on your data to give you, ultimately, you need to have deterministic outcomes for enterprise data and capturing that value and not leaching that value into another environment. So that's the dynamic that we're in today. It's the early part of that transition. But that's why the terminal value of these enterprise software businesses that have a right to thrive should be multiples of what we saw in subscription-based businesses, which are based on number of seats or seat licenses.
For an average investor, one choice is to buy the Magnificent Seven. The other choice is to invest in companies that you're identifying and investing in and helping to grow.
Right.
That's the difference between what you described, the higher volatility and lower waves.
Right.
Over the coming 5 years, given where the valuations in the public markets, by how much do you think your business is likely to outperform the public market?
They should. We've been able to outperform the public markets over the last 26 years in which we've been in business. The opportunity set, and here's a couple things. Enterprise software, 97% of software companies are private, so that's point number one. There's going to be some portion of those that have sovereignty and dominion over workflows and data sets. And so those are the ones that are equipped and positioned to thrive. The incumbents in those marketplaces, they have decades of context. They have the trust of their customers because they've been protecting their data, generating unique workflows, et cetera. So they should have the right to win in that context. And they have the ability to scale. There's certain software companies that have the ability not only to scale for the companies that they operate, but they often operate across entire industries. And so to have the unique dynamics of context for that only exists within the walls of these enterprise software companies. So it's important to know that these businesses, when they become AI enabled, they will have a right to win. They will have a right, if they build their agentic systems well, and a right to demonstrate to their customers that they are the right people to be trusted, to continue to be stewards of the enterprise data of those companies. If you think about it, what enterprise software companies have done, they've established vaults, in essence, where the enterprise data lives, the workflows, the intellectual property, the data that actually is generated by the workflows, that all lives within the enterprise. The AI native or AI startups, often they'll come and say, hey, take your data, trust me to process it and bring it back, which I think large enterprises are going to have a hard time doing, as opposed to let me bring the models, the inference capabilities inside my walls, and everything stays within there in the vault. My data stays there, it stays protected, and my business stays intact. And now let me just put out a more efficient deterministic outcome or output for my businesses. So there's the right to win as incumbents. And so from our perspective, those businesses that you can transform to become agentic are valued at a place that they're not capturing that enterprise value in what we call their terminal values. And so those are the businesses to invest in long term. Ultimately, if you weren't in the early stages of the new tool, who knows how much, depends on how much inference they can capture later. I'm not sure how much more upside there is, and you have to look at that. You've got to also look at what the power consumptions are for these businesses. Most of them are still operating in, I'll call it a learning environment as opposed to an inference environment. Inference is kind of the long-term operations and what it takes, and what's the capacity for those businesses to continue to scale and grow versus businesses that are utilizing these tools that right now are not really well understood as to what the terminal value is.
The word SaaS, or the phrase SaaS, has been getting a lot of negative news of late, and obviously we are seeing even the credit market is being hammered, that has exposure to the software businesses. How are you taking advantage in the credit market of such opportunity.
Right. So in any market that is going through a disruption, there's sentiment and there's reality. And what our job as investors is to really discern what's the activity that's driving sentiment that we could take advantage of that reflects what I call the reality of what these businesses are actually worth. And that's what we're doing in our credit business. Some companies or some holders of these are saying, listen, I'm just going to sell everything. And they're not really understanding that certain of these businesses have major inflection opportunities and convexity in terms of their returns. And so what our team is doing is evaluating these and that so they can look at the vast number of these and determine which ones they should focus on to take advantage of which companies are going to become winners in this agentic world, which companies we think likely don't have the opportunity to thrive. And part of what our ecosystem provides is, frameworks around, Vista. Again, we are managing well over $110 billion in assets, private equity and credit. And so having those two organizations be able to inform each other about what they're seeing and which of these have the right to thrive, right to accelerate, and what are the elements of that so that we can underwrite in these environments quickly. Because over time, people will start to understand the dynamic, and so of course the market arbitrage of opportunity will decrease, but we think there's a great opportunity, and it's a vast opportunity to take advantage of today.
AI is a buzzword. For some people, it's known. For others, they're just starting. Mm-hmm. How long do you think is going to be a very strong impact on businesses? Are we looking at a 2-year or a 5-year, in your opinion?
There's a new, I'm going to use the word term that's being bandied about in our world that is kind of interesting. And everyone says diffusion rates. Oh, how quickly this technology diffuses, which, as a chemical engineer, we talk about diffusion rates all the time. The diffusion rates will really be a function of how people see the efficacy of the adoption of these technologies. Part of what we do at Vista is we built our own Agentic factory. What does that really mean? It means we've created teams and pods of people with all of the major, call it the hyperscalers, utilizing their models, their technical people, et cetera, and now say, here's an agent that we want to build for a specific industry. Now we're going to take those agents, diffuse them in the marketplace. So what's that mean? That means actually go into the customers and install these systems so that they have active agents working in the customer's location and delivering the value. Well, it's going to take some time for that to be realized. Most of that's happening in private companies, but to be realized where people say, oh wow, I see the value of this. And so now, there's the arbitrage of opportunity then starts to go away. And the more successful people become, the more they will begin to utilize it. And so that's what shortens the timeline of, we'll call it, full adoption. The short answer to this question is this is a general purpose technology. It's going to hit every single industry, some faster than others, depending upon the construct. But what's interesting, and I tell our teams, you have to get there fast first, because the world in specific companies and industries is going to go from winner take most in environments to winner take all, because the capacity of these agents to do work is only going to be bounded by the amount of, call it, inference or compute that they have access to, which will outstrip, I'll call it, humans' capacity to do a lot of these sort of tasks. So I think it will be a slow, and then all of a sudden in certain industries you'll just see a spike of the entire industry, and then will become agentic. And people will view that, and those agentic winners will become very large relative to others, and other industries will say, well, now I need to adopt a lot quicker. So that's what I think the diffusion rate will be of this technology across industries.
We at our firm have implemented that Agentic, and I was really surprised how fast the adoption, even for our employees, and the impact on them. Although it's almost like shooting yourself in the foot, because you're basically hiring an agent to do something better than what you do. Mm-hmm. But people are enjoying it, people are seeing the value of it and making them smarter and moving on. So That's something that I think I'm of the camp that of a 2-year as opposed to a 5-year.
What's interesting, Abdulmohsin, is the fact that a lot has come, when you talk about how long it takes, it's a function of leadership. You and I have known each other long enough to know that, you are a visionary leader, and as a result of that, your team follows that direction. I'll tell you, we think about our world in many places. Companies that are run by people who understand products are going to, adopt this technology much more quickly than those who are run by people who focus on, just operations. And so those who are more product oriented, my sense is, will actually accelerate much more quickly in that environment. And their people will, like all things, is that, the paradox of, hey, listen, Jeff's paradox, that the more productive it becomes, the more you use it. And that's what's actually happening. So you're like, wow, this is actually very effective now, let me build more, and it becomes even more effective, well, let me build more, it becomes more effective. The rate limiting step to this, however, which people aren't talking about yet, is what's that cost? What the cost is inference, the compute cycles it takes for those agents to operate. Today, literally today, we're at a point where I call it consume as much as you want, introductory low price. Well, we're running out of compute capacity for the way that inference is delivered, because it's most of it's being delivered in infrastructure that's actually built for training, not for inference. So it's inefficient for inference. And so it uses a tremendous amount of energy where it doesn't have to if you're just using it for inference in the way that the compute goes through these models. So at some point there will be a constraint until the inference infrastructures are built out at a capacity where it's much more affordable long-term at scale. If you have 5 agents, if you have 10 agents, and they're working 24/7, 365, the energy consumption, depending upon how you use it, can be enormous, or can be a fraction of the energy going through the existing platforms today, and that actually makes it a very economic proposition for you.
One last question. What's your advice for a GC investor who wants to keep the money for multi-generation? What would be your advice in this environment?
First, it's really, really important to find very strong, educated, I call it curious advisors to help educate you on what it actually is occurring and where. A lot of this technology is moving quite quickly. This technology is going to hit everything. There is no industry that it will likely not affect. And so you need to have advisors who are actually engaged, who are global, who are thoughtful, and are bringing the not just the ideas, but formulated thoughts on here's where we think investment opportunities are in our marketplace. So that's kind of point number one. Point number two is be willing to take some risk in some areas that may not know. Like all things, everybody can identify the downside, but there's some massive upside in a lot of these opportunities, and you should look to take advantage of that before it's well known. Because once the upside's well known, then there's no pricing arbitrage and no opportunity to take advantage of it. You still have to maintain what I call a diversified portfolio in effect. And in the way our world is evolving today, I think you have to be kind of geographically diversified as well. But look to we always talk about look to where the action is going, and in my view, looking for institutions that actually know how to create conversions using this new technology is probably a smart way to play this. So you're not buying at a peak or there's no longer any growth, but taking advantage of systemic rises in values and opportunity with folks who know how to make those conversions and transformations. So those would be my thoughts.
Thank you very much for your time. I really appreciate it.
Always a pleasure. Yeah, good to see you.
Thank you.
All right, thank you.